Hi, this is Trevor, and today we're talking about promissory notes. A promissory note is the document used to show the evidence of debt in the case of a loan and the promise on the part of the borrower to repay the loan and the conditions under which those repayments are made. Important to note is that typically loans are made with recourse, and recourse means that the borrower is personally liable for the total amount of the debt regardless of whether or not there is enough security or collateral to cover that debt in the event of foreclosure. Sometimes loans can be what's called non-recourse, in which case it is only the collateral that is used to cover the debt in case of default, but that would need to be specifically defined in the loan documents. The first, of course, is the loan amount. This is the amount of money that is loaned to the borrower and is typically referred to as the principal amount. As the loan is being paid down, the amount that is left to be repaid is typically called the unpaid principal balance. Most often, loans are advanced with all of the principal loaned to the borrower up front, but that's not always the case. There are other types of loans like construction loans, lines of credit, where advances can be made incrementally or in separate parts. The next component is the interest rate. The interest rate is the cost that the borrower pays to the lender for the use of their funds. The interest rate is expressed in annual terms, such as 6% per year, and that's what we call the nominal rate. It's important to understand that the nominal rate can be different than the effective rate, which we cover in a different video. And the interest rate can be either fixed or adjustable depending on the type of loan that's being made. The next thing outlined in the promissory note is the monthly or annual payments, depending on how the loan is structured. The promissory note will designate the number of payments, the amount of the payments, and the date on which each payment is due, whether it be monthly, annually, quarterly, what have you. The note also designates the application of payments. Payments can be put towards interest, principal, fees, and other items. The promissory note will designate in what order those payments are applied. Typically, in real estate, we see payments are applied to any outstanding fees, then interest, and then whatever's left over is applied to the principal. Next is the maturity date. The maturity date determines the term of the loan or the length of the loan, and the maturity date is the date on which all unpaid principal balance is due. Along with the maturity date is the amortization. Quite often the amortization and the term of the loan are the same, say 30 years, but not always. Sometimes the term of the loan will be shorter, but payments will be amortized over a longer period. In that case, we end up with something called a balloon payment at the end of the term of the loan. The promissory note also designates the property or the collateral to secure the loan. Usually in real estate, this is accompanied by a mortgage document or a deed of trust that links the promissory note and the collateral together. In the event of default, the lender can sue on the note and foreclose on the mortgage, going after the security or the collateral at the same time. Default is when the terms of the note have been violated by either non-payment or what we call technical default, when, say, the borrower doesn't maintain the property to the appropriate levels or fails to pay their property taxes. But default can trigger a whole bunch of other actions that can be enforced on the note. When default happens, the lender issues a notice of default and invokes what they call the acceleration clause. And that means that the loan has been accelerated to the end and all amounts that are payable are now due. This is usually the first step in the process on the way to foreclosure. The next provision is what's called the prepayment provision. It's important to note that typically when a loan is made, prepayment or paying the loan off early is considered a privilege, not a right. Lenders make loans for the purpose of earning interest on the money they lend. And if a loan is repaid early, the lender is not able to make the yield that they were expecting. So typically there's what's called a prepayment penalty in the event that a loan payment is made above the principal amount that's due, or if a loan is paid off early. Prepayment penalty provisions can be structured in various different ways. It can be a step-down prepayment penalty as a percentage of the unpaid principal balance, Or there are other formulas that can be used, such as yield maintenance or defeasance, which are calculations that allow the lender to maintain the yield they would have had if the loan had not been prepaid early. Most loans will also have an assumability clause, which is the ability for the borrower to substitute another borrower in their place. This is pretty common when someone sells a piece of property and the new buyer wants to take over the existing loan. The loan will have provisions in there for what must be done for a new borrower to assume the loan. There's also what's typically called an assumption fee, which is similar to an application or an origination fee, in that the new borrower who is trying to assume the loan will pay a fee to the lender in order to process the loan assumption. Promissory notes also have what's called an assignment clause, which gives the lender the right to sell the note to another investor or another lender, and all of the rights contained in the promissory note are transferred to the new loan owner. That doesn't affect the borrower in any way, but it's very common in the mortgage industry, and it's effectively what creates the secondary mortgage market. Obviously, there can be a lot more provisions or components to promissory notes, but these are the basic ones that you should expect to see in virtually every note, and it's important to understand how they all work. This has been our quick lesson on promissory notes. Thanks for watching.